Hello, everyone, and welcome. My name is Janice, and I run the Low Income Taxpayer Clinic here at Maryland Volunteer Lawyers Service. I want to thank you for joining us today, and just remind everyone that we have started our new pro bono portal, and this is a new thing for MVLS. We just started it, and it's a great way to look up cases, what available cases there are. As you can see, it's separated into various categories. And so for those of you who are interested in tax, if you scroll over to the tax bar, you'll be able to see any available tax cases. So we do encourage you and invite you to join us on our volunteer panel. So we're going to move along here. And we have some additional trainings coming up as well. Next Wednesday, we have an offer in compromise training. This is an in-person training in Annapolis at the Office of Frost & Associates. And then later in the month, we also have a webinar from the Office of Commissioner of Financial Regulation. So, all right. So we are very lucky today to have Andrew Marshall joining us today. He's going to be speaking about the Domestic Voluntary Disclosure Program. And so I'm going to let Andrew take it from here.
Okay,
Andrew?
thank you very much. And
Can you hear me?
good afternoon, everyone. And thank you, Janice, for inviting me to speak to you all. I am Andrew Marshall. As the slide suggests, I'm the technical liaison for examination programs to the executive director of TAS Systemic Advocacy. So I am located in Seattle, where last I checked it is 59 degrees and raining, so typical summer weather out here in Seattle. I understand folks in Maryland are quite a bit warmer, but this is kind of a continuation of a talk that we did a couple of months ago on the offshore voluntary disclosure programs. And what I'd like to talk to you today about, and hopefully get some conversations going, is just that voluntary disclosure programs within the IRS aren't limited to offshore accounts. Those are the ones that get more press and more attention because there are disclosure regimes in place, as we discussed, that can include reduced penalties and have varying requirements of what a taxpayer needs to do to be quote unquote accepted into the program. Domestic programs are different. It's a much more simplified process, but as we'll see, there still are some components of qualifying as a disclosure, and really, just kind of wondering why would someone want to enter into a domestic voluntary disclosure program? What is it? What are the requirements? And where can you go for additional information? Next slide, please.
Great, and I'm sorry, I forgot to mention this, that we do welcome questions. If you could type your question into the question box. We're going to try to hold the questions until the end of the session, just to not interrupt the flow, but please feel free to write it in the question if you do have one. Thank you.
So when does a voluntary disclosure occur? And the title of this presentation was "Help My Client Made a Mistake." Since you're acting as kind of a whistleblower for your own return by voluntarily disclosing something to the IRS, perhaps a more accurate title would be, "Help My Client Had an Ethical Lapse," or, "Help My Client is Hearing Very Loud Knocks on Their Front Door," because a voluntary disclosure begins with the taxpayer reporting something on their own return. And so when we usually see people doing this is when either they see the writing on the wall, where they've been involved in something that they think the IRS is about to find out about. A lot of times it has to do with interpersonal relationships. So for example, a person's going through a divorce and they know that their spouse knows what they've been involved with in various domestic tax shelters or underreporting. And so basically they want to get to the IRS first to come clean and try to solve their previous tax problems. And so really, but I guess before we get too far into defining disclosure, when a client comes up to you and says, I have been involved in these programs, from these previous years, what do I do now? Of course, there are three main options of what you can do, right? The first, of course, is the client can do nothing and just hope that the IRS doesn't catch them and that, things work out. The second thing that they can do is make what's called a quiet disclosure, which involves just going back, amending returns to include the omitted items and crossing your fingers that it doesn't pique the IRS's interest to open a formal examination, which of course could lead to penalties and in some cases criminal prosecution. And the third is entering into some sort of voluntary disclosure program. And that occurs when a taxpayer communicates truthfully, timely, and completely with the IRS, showing a willingness to cooperate and in determining his or her correct tax liability for the year. And the taxpayer makes good faith arrangements with the IRS to pay in full tax, interest, and any penalties determined to be applicable. And notice that, it's just making good faith arrangements. A taxpayer doesn't need to have, a check for the complete amount in order to enter into these programs. But basically, it's just, coming forward with the whole story, complete information, and making this disclosure timely. And again, in this panel, we're going to be discussing domestic disclosures. So, this is outside the construct of the OVDP programs, offshore voluntary disclosure programs, that involve specified foreign assets or accounts. This is just, for domestic programs. So next slide, please. So the general rule for the disclosure programs, no substantive or procedural rights are created for taxpayers. These disclosure practices are just guidelines for IRS personnel. And so much like what your clients will see in any sort of administrative hearing, like an administrative appeal, and so on, a taxpayer can't come to the IRS and say, hey, look, this other person in a similar situation wasn't recommended for prosecution in my case, therefore you can't prosecute me either. Another person I know got this deal, so you must offer me the same deal. There's no rights are created, but these are guidelines for IRS personnel to use to try and create some uniformity in the disclosure programs. It also doesn't automatically guarantee immunity from prosecution, but it may result in prosecution not being recommended. And finally, and most importantly, it does not apply to taxpayers with illegally sourced income. And the reason I say, it's increasingly important now is I use the example of people involved in the marijuana industry. And, here in Washington, and I think in 27 other states as well, there's some sort of marijuana legalization on a state level, but it still is a Schedule I controlled substance for purposes of the Controlled Substances Act, which means that it is considered illegal federally for purposes of IRC Section 280E, which affects, the deductions that can be taken against illegally sourced income. And I used Olive versus Commissioner as an example. Even medical marijuana dispensaries are still considered illegal trafficking. So if you have, for example, a client that runs a marijuana dispensary in a state where it's legal, that is still considered illegally sourced income for purposes of IRS disclosure program. Next slide, please. So when can it be too late, though? If someone, comes and says, here's my situation, am I eligible for making a voluntary disclosure to the IRS? And most of these, just align with common sense. It's generally too late when the IRS has already started some sort of examination, either a civil or criminal one, or has notified the taxpayer that intends to commence such an examination or investigation. And again, there's no sense fessing up when the IRS is already aware or about to be aware of the activity anyway. If the IRS has received information from a third party, informant, other governmental agency, or the media alerting the IRS to the specific taxpayer's noncompliance. Other governmental agency can include state regulatory agencies. So for example, someone's audited by the California Franchise Tax Board, and they know that California has already sent information to the IRS about this activity, then it could be too late for the taxpayer to begin a disclosure with the federal government. If the IRS has initiated a civil examination or criminal investigation which is directly related to the specific liability of the taxpayer, we'll get into some examples of that in a moment, but that's basically, if the IRS has started a civil or criminal investigation into, say, a partnership in which your client is a partner, that is directly related to your client's specific liability. Or if the IRS has acquired information directly related to the specific liability of the taxpayer from some criminal enforcement action, such as a search warrant or a grand jury subpoena. Next slide, please. So we're going to begin kind of backwards, since we've said, okay, what is a timely disclosure? When can it be too late? Rather than saying what is disclosure, let's begin by saying what's not voluntary disclosure, because there really is. It's more of a entrance into the program by exclusion, if you will, where there are examples of, okay, we're not going to define every single situation in which disclosure can be considered voluntary and timely, but we do know here are some that are not. So the examples that I gave here, a letter from an attorney stating that his or her client who wishes to remain anonymous wants to resolve his or her tax liability. Again, the identity of the taxpayer has to be disclosed in order to make it a voluntary disclosure. All the information has to be given to the IRS in order to ascertain the correct tax liability. And of course, the name of the taxpayer involved is one piece of that information. A disclosure made by a taxpayer who is under grand jury investigation. Again, the IRS is already aware of the taxpayer's activities. There's, grand jury investigations have already begun, so a disclosure at that time would not be permitted in the domestic voluntary disclosure program. A disclosure made by a taxpayer who is not currently under examination or investigation of omitted gross receipts from a partnership whose partner is already under investigation. Again, since the IRS has already initiated an examination that is going to be directly related to the liability of your client, that is not a voluntary disclosure at this point. The same thing in the next example of a client who is not currently under examination or investigation of omitted constructive dividends received from a corporation which is currently under examination. Again, the difference between this and the last example is that even though corporation is a separate legal entity, your client as a shareholder of that corporation or someone who has received some sort of constructive dividend from that corporation is still considered to be directly related to that tax liability. And then finally, disclosure made by a taxpayer after an employee has contacted the IRS regarding a taxpayer's double set of books. Again, the IRS has already been informed of the activity, even if no examination or investigation has commenced. So, these are situations where, again, even if your client hasn't received notice from the IRS that an audit has begun, if they're aware that a disgruntled employee or partner has already gone to the IRS, it may be too late at that time to begin a voluntary disclosure. Next slide, please. So here are some situations, and I apologize. It looks like the slide got cut off a bit. But these are situations, though, where although you wouldn't think that they're considered disclosures, they actually are. And so in this case, a disclosure made by a taxpayer of omitted income facilitated through a widely promoted scheme that is the subject of an IRS civil compliance project. So although the IRS has already obtained information which might lead to an examination of the taxpayer, it has not yet commenced any such examination or investigation or notified the taxpayer of its intent to do so. This can be considered a voluntary disclosure because that compliance project does not yet directly relate to the specific liability of the taxpayer, provided the taxpayer, your client, files complete and accurate returns, makes arrangements with the IRS to pay in full tax, interest, and penalties, so on. So looking at this for a minute, how is it different from the situations we were talking about with partnerships and corporations? What's important here is that the IRS is simply looking at a scheme. So take, like a listed transaction, for example, son of boss. If the IRS is looking at a specific transaction, but does not yet have, a client list or something that links your client directly to the IRS or even tangentially through a corporation or partnership, if they're just looking at a scheme itself, then your client may still be eligible to come forward and make a voluntary disclosure at that point. Another kind of interesting nuance is non-filers. Even if the IRS has sent a notice that has no record of receiving a return for a particular year, they can voluntarily disclose because the IRS has not yet commenced an examination or investigation of the taxpayer. The or notified them that they are about to do so. So what does that mean? I think a good example there would be if some sort of automated soft notice comes out saying, hey, we don't have a record of receiving a 1065 for this period or your 1040 for this period. As long as the IRS isn't opening an examination, so for example, if the IRS is not sending some sort of substitute for return notification, audit report, anything under 6020B, if the IRS is just sending a soft notice, then your client may still be able to voluntarily disclose because an examination or investigation of the taxpayer hasn't yet started. But once they receive some sort of automated substitute for return, it may be too late at that point. Next slide, please. Okay, so how do we make a voluntary disclosure then? after talking to your client about the facts and circumstances of their situation, you've decided that, it is in their best interests to come forward, that, the disclosure is timely, then you can make this voluntary disclosure by fax to the number provided, including the name, date of birth, social security number, and address of your client, or by mail, to the domestic voluntary disclosure coordinator in Philadelphia, and just include a executed power of attorney form for the periods that you are representing your client, so that you can receive notices and communications as appropriate. One thing to notice is that the domestic voluntary disclosure program is run by criminal investigation. And so that's why, joking at the beginning of this talk that, it's not really so much my client made a mistake, but, these disclosures are when your client is pretty much aware of what they did and when they did it and now wants to come clean. And the next slide, please. And if you have further questions about the program, there is a CI voluntary disclosure hotline at 267-466-1607. And this hotline can answer questions for both offshore and domestic disclosures. You can also find information online at irs.gov. I would recommend the Internal Revenue Manual as a good source of information. The examples that I took for this slide, or for the slideshow, is largely from IRM 9.5.11.9 regarding criminal investigations voluntary disclosure practices. So at this time, I would just like to open it up to questions, comments.
Great. So thank you, Andrew, for that very, very comprehensive and easy to understand slideshow. It was easy to follow. So I do want to mention to anybody that who has a question, please go ahead and type that into the box now. I do see a question already about whether the slides will be available, and yes, indeed, these slides as well as the recorded webinar will be available. This is a little bit different from the last talk that Andrew did. Andrew, I know you were concerned about putting those up because you thought there might be a change, and indeed, I think it was like the next day there was a change in the wasn't there? So that was a little bit crazy, and you were very prescient there. So, but as far as you know, this is going to say pretty much the same then, and nothing's going to change here. That's your understanding, correct, Andrew?
Correct, because again, unlike the offshore programs, and people who have attended the last one can see, this is a much less loosely structured program, and so because there are no, I hate to use the word amnesty, but any sort of penalty abatement offers or specific program benefits. This one is, just a way for taxpayers to come back into compliance.
Okay, and so that leads us to our next question then, which is, so what happens in the end? Is there an equivalent of an amended return or discretionary penalties? And then, go ahead.
Okay, so yes, and as so like we said, an amended return by itself with no coordination through the domestic voluntary disclosure program is considered just a quiet disclosure. And so that would just be like submitting any sort of amended return to include previously omitted information. The IRS may decide at that point to pick it up for examination. And so what that could mean is, if there's a 25% omission of gross income, that could lead to a 6-year statute of limitations for the IRS to examine the return. Civil fraud, of course, has no statute of limitations. If you enter into domestic voluntary disclosure, again, the carrot side of this program, quite honestly, is kind of a baby carrot, where all you're getting in return is that the IRS might not refer you for criminal prosecution. Because again, as we pointed out earlier, there is no guarantee that the IRS will not criminally prosecute. And so, of course, the question becomes, well, then why on earth would anyone really do this? And that's where it really is a facts and circumstances based conversation with your client, where, and I'm going to speak bluntly here, it's generally a matter of beating someone else to the punch, where, you're throwing yourself on the mercy of the court. It's, akin to doing a situation where you're a teenager, your parents have gone out for vacation, and, while they're gone, you break your mom's favorite lamp. Do you tell her and throw yourself on the mercy of the court, or do you sweep the shards under the rug and hope no one notices until you're safely off to college? It's that kind of deal right there.
All right. Well, I think you've just answered our next question, which is, what is the incentive for voluntary disclosure? Since most taxpayers will hesitate, what would a representative say to encourage them? So.
And I think that other than, of course, the ethics or the morality of just, coming back into compliance, it is true what they say, confession is good for the soul. I can almost feel people rolling their eyes at this point, but, there is something to be said for finality, where if you're coming at this from the client's perspective, and either, they're looking as the IRS is issuing John Doe summonses for schemes similar to what they know they were involved in, or may even still be involved in. They may want to come forward just to, get this sword, from dangling over their head the whole time. Or if they've been, engaged in a business where they're paying people under the table, and, there's already some rumblings going on from disgruntled contractors, like, well, I might just call the state, or I'll call the IRS on you. Again, it's, there's a lot of psychological pressure there. And we've talked about, pretty much any interpersonal conflict. So, we've talked about divorce. I've seen it in inheritances, where, you have families fighting over money. And so, I guess never underestimate the the power of vindictiveness either, where sometimes people are willing to cut off their nose to spite their partner or their family member. Or
Yes. Wow. Well, certainly that is very much of an incentive there, that psychological distress that someone could experience. So, great. So here's a question about, you mentioned that if a partner is already under investigation, a taxpayer is not eligible for voluntary disclosure. Does this apply only to business partners, or does it apply to personal partners also?
If I could get some clarification, are we talking about personal partners like domestic partners, or are we talking about personal partners like you're involved in some sort of like loose syndication business that isn't like a recognized entity? Or
let's talk about both. Let's start with personal partners as like a domestic partner.
Okay. So a domestic partner, I mean, and again, this is why it's important to nail down specifics with your clients, and to really have and why honestly your counsel and expertise in this is going to be so important, because the answer is, it depends. It depends on how much information the IRS already has at this point. So if if some sort of, as we talked about in a previous slide, if the IRS has already received information from some sort of whistleblower, be it a disgruntled employee, be it a state entity, or any other individual, then your client may no longer be eligible for the program because the IRS already has that information. Conversely, just because the IRS has initiated an examination of a person who is not yet directly related to your tax liability, so an unmarried domestic partner, friend of the family, loose business associate where you just went in on some sort of joint venture, if the IRS hasn't already been notified that there's something wrong that can lead to you, then yes, you still may make a timely domestic disclosure at that point. Does that make sense?
Yes, I think it does. So, well, here's a question though, that if, I guess is there any benefit or is there any opportunity if you rat on yourself, does it allow the IRS to go after a broader scheme, such as an advisor directing multiple clients? I guess, would there be any benefit or to yourself if you, like, could you do a plea bargain kind of thing, I guess? Is that something that can happen?
You could. And again, this is going to be part of a negotiation, but I hesitate to say you could definitely do some sort of plea because, first of all, as we've discussed, there are no guarantees that the IRS is going to make, period. Second of all, though, remember one of the elements of making a voluntary disclosure is giving complete, truthful information. And so if you're providing information about yourself but withholding, for example, information on what sort of scheme you were involved in to try and elicit a better deal for yourself, the IRS may come back and say, you know what, you're not disclosing in good faith. You need to provide all the information about, what sort of activity you were involved in, where this deficiency in tax came from, in order to be part of the disclosure regime. That being said, if for example, your client brings to the IRS's attention some sort of, shelter or listed transaction that's going on in a local sense that they haven't picked up, then yeah, the IRS may say, okay, in exchange for not criminally prosecuting you, you testify, in this, yes, they may do something like that.
Okay, great. So here's a question about the general turnaround time. Once you've received notice that your client has been preliminarily accepted into the domestic voluntary disclosure program, what would be the turnaround time, I guess? Is there a backlog of cases?
That is a good question. I can check on that. I am not aware of a backlog, but I do not know for sure. But I am not aware of any existing backlog.
Okay. Okay. And here's a sort of a specific question from a client. From someone who seems to be a tax return preparer. So this is a Canadian client of 7 years who finally admitted to me her other accounts, such as retirement plan, school plan, and savings plan. We found a firm that specializes in the VDP area. And how long as a preparer do I have to worry about the IRS coming back on me as the preparer? I have a valid letter of engagement that she signed that covers this, but I'm still concerned. I guess it's because the client has just disclosed all these other things. Does that affect the preparer in any way if the preparer did not know about it?
Of course, I would err on the side of keeping the records the preparer has. In terms of any liability under, for example, 6694 A or B preparer penalties, again, it's, even if the preparer did not know, did he or she have reason to know? If the answer to that is no, then probably there's nothing to worry about. Of course, if there is any question, just more documentation as to what you, for example, your engagement letter with the client, what sort of interview was conducted, what information the client provided, whether or not they had complete books or records, keeping that sort of trail that the IRS can follow could be very helpful in any sort of preparer investigation that would ensue.
Yes. Well, okay, thank you. And then we have another question here about, do you have any statistics on numbers of taxpayers who make voluntary disclosures who are also criminally prosecuted? In other words, even if the service does not promise to refrain from criminal prosecution, does it often do so as a practical matter?
I don't have any statistics. As you can probably understand, CI is loath to release statistics, especially of cases that have not yet begun to be litigated. So, for example, we really wouldn't know the absolute number of faxes or letters that came in to CI. I will say, as a practical matter, that, and this is just me talking, not the official IRS. One would think that CI would not engage in consistent bait and switches, which I think is what the questioner is getting at, where someone comes forward saying, hey, I have a disclosure, CI says, nope, not eligible, and then uses that information to prosecute them. As a business matter, you would not really do that, because at the end of the day, the government does want people to come into compliance. It's not just about dollars and cents, but it is, about that overarching goal of enhancing voluntary compliance, right? And, operating under some, again, bait and switch regime would be contrary to that. But I don't have any hard statistics about the amount of people accepted, or, which ones eventually get sent for a criminal prosecution anyway.
Okay. Well, I can understand that. So here's a question. Once a person is flagged in the VDP, is their account handled any differently for filing purposes? For example, do they get a special number assigned to them that they're under the microscope for a set number of years? Is the IRS going to be paying attention to them more closely for a while, or?
Anything regarding customer accounts can run into official use only information, so I can't give a specific answer to that. I will just say that yes, there are some, because this program is administered by criminal investigation, for the year in which the disclosure occurs, or excuse me, not the year in which the disclosure occurs, but for the affected years, then yes, your client's account is going to be held, while the investigation commences. But for any subsequent year flags or anything, I can't really get into that.
Interesting. Wow. Okay. For anybody else who has a question, please go ahead and type that in now, and we'll be happy to answer those. I think we've had some very excellent questions so far, and thought-provoking. It certainly is an interesting concept to present to your client, when the potential consequences can be so high, but yet, like you said, it's sort of a little carrot as opposed to a big carrot. And you sort of have to appeal to your client's sense of doing the right thing.
Yeah, and also, though, from a practitioner standpoint, again, you may be, I'm sure we've all had situations where it's kind of like the person coming up to a cocktail party, like, oh, you're a doctor, what's this lump mean? You could have people come up to you saying, hey, so, if I was involved in some sort of, like in the 1980s when all the cattle shelters were popular, what do you think I should do? Just having an idea of that these programs exist and what the general rules are can be very helpful. One other situation I'd like to throw out for your consideration is I've personally seen cases where we'll have, given industry consolidation, you may have a client that for years and years had their tax returns prepared by a local or, mid-sized statewide firm who was then absorbed into a larger firm that may not have the same ethics. So all of a sudden their returns are, still getting prepared, but the client is now encouraged to engage in, foreign currency transactions and, interest swaps, transferee cases, things like that. It's not always just a matter of underreporting sales or paying people under the table. Sometimes there are gray areas where people know something's not right and continue to do it for a while, but again, there's just that nagging feeling that they want to get back into compliance. So, again, it may arise more situationally than you might think at first glance.
So we have a question now. Does the IRS view voluntary disclosure differently from a quiet disclosure? In other words, would voluntary disclosure be likely to yield a better result than a quiet disclosure made simply by filing an amended return?
Well, a better result in terms of tax deficiency and so on, no, because, the ultimate goal under either scenario is to get at what is the proper tax liability for your client for a particular year. The main difference is going to be what is your client's exposure to penalties, be they criminal or civil, or, prosecution. So, that's the only area in which coming forward and making a voluntary disclosure could have an impact, is the IRS agreeing not to criminally prosecute.
Well, that seems like that would be a very big incentive. Okay. Well, great. So, well, I think we've addressed all of the questions here. Thank you, everyone, for submitting questions. I think this has brought up a really interesting discussion here and allowed us to apply this basic information to different situations. Oh, wait. Yes. So anyways, we have a comment that this was wonderful. Thank you very much for that comment.
Oh, thank you.
And thank you again, Andrew, for this very helpful information. Like you said, it probably happens more frequently than we think it does. But I think we also, as practitioners, have to be aware that there are opportunities for clients to come forward, and how we can encourage them. Having a better understanding like this is helpful in knowing how to counsel our clients and how to encourage them to come forward. It can be extremely scary for clients, especially in dealing with the IRS, and certainly nobody wants to admit that they did something wrong. But sometimes it's better to go ahead, like you said, to go ahead and throw yourself upon the mercy of your mother so that she doesn't find the lamp shards under the sofa later on. So, very good. Well, thank you, everyone, for joining us. And again, we appreciate your interest in our webinars and the information that we have. And we encourage everyone to join our volunteer panel if you haven't, so that you can put some of this information into practice. So thanks again, and we will talk to you next month. Thanks. Thank you, Andrew.
Thank you all.
Bye-bye.
Bye-bye.